Let me start with asking you, the ECB is expected to cut rates this week in response to the tariff shocks. How effective could this be in stabilizing Europe's economy from your point of view?
I'm delighted to join you today. There's a cruel irony to the current situation in Europe, because I would say in the medium term, so in the next 6, 7, 9 months, in the medium term, the macroeconomic circumstances of Europe don't look great. They are a continuation, if you will, of the slow economic and industrial decline of Europe. But ironically, and this is really a strange situation, ironically, because of decisions taken by the White House in the past 10 days, and the flip-flop, the aggressive flip-flops and reversal of decisions taken by the White House, the situation now in Europe looks quite good. So everything is relative in finance. Nothing is absolute. So because global investors, international investors, were a bit, shocked, destabilized, some of them were horrified by the decision taken in the US in the past 10 days, they are parking their money. One of the things, one of the functions of the bond markets is to be used as a parking lot where you stash your money, your cash, right? Because bonds are by definition more liquid than other assets. And so there is a flight away from US treasury bills, treasury bonds, to alternatives. And rightly or wrongly, European government bonds, especially German, Dutch, Belgian, Danish, but also French, bonds, are viewed as an alternative. So all that is good for the ECB because it means global money, international money is flowing into euro-denominated government bonds, which makes the ECB's life easier. So now, President Trump decided to focus on China for the next 3 months. So for the next 3 months, in the short, medium term, the rest of the world, including Europe and Canada, they got a respite, they got a reprieve, and it's good for bond markets. Also, something else which is quite good for bond markets in Europe is inflation. In Europe, inflation is better contained than in England, the UK, or Canada, or the US. So because also inflation is low, it's also making the ECB's life easier. So for all these reasons, probably when they meet on Thursday, in 5 days from now, the ECB board members will likely lower a little bit the base rate, maybe by 25 basis points, so it should go from 250 to 225, just to give a bit of oxygen to the European economy in that still fairly volatile environment, but much less volatile than 5 days ago.
Then how do you explain the difference in response between the ECB and the Bank of Canada, who are likely to hold rates?
So probably the main difference is inflation. I think inflation is higher in Canada, so that's a factor. Another factor is the following: the Canadians and the Mexicans in the past months, they've been through a roller coaster ride of brutal, absorbing the shock of abrupt, brutal decision taken by the White House, and surprisingly, so far, the Canadian economy has swallowed that shock quite well. So most experts thought that after 5 weeks of very brutal pressure, at the end of the day, Canadian, companies, Canadian industrial companies would see their, production, their output go down, investment would collapse, real estate would collapse. So far, there is a small slowdown, yes, in industrial output and the real estate market in Quebec and Ontario, it's true, but there's no collapse. surprisingly, even surprisingly, even for the Canadians themselves, it's a good surprise. They are discovering that their economy seems to be so far more resilient than they thought, and probably it's giving the central bankers self-confidence. So they feel that the crisis so far is not that bad, and they don't need to lower the rate, especially that inflation in Canada is higher than Europe. But the rates are, and this is interesting, the rates in Canada now, the main baseline rates are 275. In Europe, they are at 250 on average. So fairly similar to Europe. If you look at England, Britain, or the US, interest rates are at 450, 460. So already the Canadians have interest rates much lower than the Brits or the Americans, which is not bad considering the circumstances. Probably they don't want to go any lower.
You think they are withstanding this shake? Now, with the Fed not meeting until May, does this leave a dangerous vacuum in global monetary coordination?
Good question. Very good question. Very complicated because now the situation is murky and there are lots of parameters or variables. I think most of the problem is mental. So traders, investors, global investors, the people I mentioned earlier who have trillions of dollars, and they need to park their money, right? And they're parking their money, their hundreds of billions of dollars or euros, into safe havens. They've been a bit under stress for the past 5 weeks, so they're becoming oversensitive, more nervous perhaps than they should be. So any negative news could be overinterpreted by the market, and it may push some people to overreact. So what I'm coming at now is that I think that gold probably will keep on rising. I think, gold is not big enough and broad enough as an asset class to become an alternative to US Treasury bonds or European bonds, but partly, it's offering the perception of a safe haven. So I think, many sovereign funds, central banks, big public pension funds are going to invest more and more into gold. So I think gold will keep on rising. I think, Switzerland, for example, if you look at Switzerland, rates now are at 0.2%. It's very low, and yet there's a lot of demand. So international financiers, investors, they're parking trillions in Swiss franc because they view it as super safe. So they're happy, quote unquote, earning only 0.2%, whereas in America they can earn 4.5 or 5% because they view Swiss government bonds like gold as safe haven. So I think there's that aspect because people are afraid of taking risk because the situation is murky and volatile. Big investors, pension funds, sovereign funds, they will accept a lower rate provided that it's safe.
So you're saying here, sir, that as the Fed are not meeting until May, they are leaving other economies and definitely other countries to weigh their options, right? Okay, Mr. I guess that we'll have to end it here because our time is out. And Mr. Maher Nicolas Firzli, thank you so much for your analysis here.